Welcome to Unit 14, Divergences. Okay, in this lesson, I want to discuss divergences briefly because I see it a lot. It's particularly with indicator traders. You're going to see it as a new trader. You're probably going to be looking around, trying to find information. You're going to see people talking about divergences. I want to just give you a little bit more in depth of what's actually happening and what they mean, and probably things that they may not even be aware of. Okay, so to get started, what's a divergence? Divergence is a situation that occurs when two lines on a chart move in opposite directions. So people often look for divergences when they're comparing the direction of price and, say, the direction of an indicator. More often than not, they're looking at momentum indicators. So in this example, I have MACD, but you could use RSI, you could use TTM squeeze, you could use stochastics. Pretty much any momentum indicator is going to show you a divergence at some point. In the example, there are two types of divergences. There are positive and negatives. A positive divergence occurs when an indicator is moving higher while price is declining. So if I just put right here, indicator is moving higher, so this is positive because the price was declining, your indicator was moving higher. If you guys can see that, sort of have it lined up. And then there's the negative where the indicator is moving down, where price is increasing or rising. So that's essentially all you have in terms of indicators. People will talk about positive cycles, and they'll talk about diverge, converge, they'll talk about what cycle are we in, what is it doing, et cetera, et cetera. And keep in mind the things that you've already learned, you are going to see what accumulation and distribution on what smaller time frames first. So in this chart, it's $, 15 minute. And you're already starting to see in these examples, positive divergence, negative divergence, declining price, increasing price. Now, keep in mind that these are lagging, and what it's telling you is there's a change in momentum within whatever trend you're looking at, okay? One thing I want to show you is we're starting to put things together, so I'm just going to move this down, this indicator out of the way so we can actually pay attention to the price for a moment. And what I want you to see is what happened here. What do we have? We formed a what? This is a falling wedge, which we've learned this as what? An accumulation pattern. And what do we expect to happen when we start seeing accumulation? We expect to move higher. What do we get? We got to move higher, did we not? Of course. So that's really what this is telling you. It's telling you the change in momentum, which if you've been paying attention, you can sort of put together now that the accumulation and distribution processes are simply the change in momentum. Remember, we talked about the physics behind the market, the bullish and bearish momentum that's generated from trend. This is what it's showing you. It's showing you divergences, or it's showing you the change in momentum. But if you can already spot accumulation and distribution, then you already know and you can logically infer that that's happening, so that you don't even need to use the indicator. It's there as a tool to help you verify what you're already seeing with price. That's how I would use it. Okay, what about up here? What do we have here? Let me just draw this out because I can see it's a little more complicated. But what do you have? You have a head and shoulders pattern. The left shoulder, the head, the right shoulder. And then what followed it? A move down. So you had this negative divergence on your MACD. Price was continuing higher. So you're seeing the distribution pattern play out within a move lower. And what does the move lower target? It just so happens that it targets prior accumulation, correct? Now, we could get more detailed than that, but for this lesson, that's really all I want you to take from it. Just understand that you've got multiple time frames and you've got price slowing down momentum from these higher time frames, spilling into the lower time frames, and it creates these momentum divergences if you're using an indicator. That's really all you need to take from this. There are different types that people have gone into detail, and they're giving you examples of this type of divergence, that type, but that's the basics. Learn to spot it, and then you can sort of realize that you don't necessarily need it per se, and that you can move on, but you see what it really is. That's all I want you to take from this.